Right. Well, hello everyone, and welcome to our webinar today. Thanks so much for taking the time to join us. I'm Megan, and I'm on the marketing team here at SESAMm. Quickly, just before we get started, just wanted to tackle a few logistics. We do have a Q&A button at the bottom, so feel free to add any of your questions throughout the webinar. We will try and get through as many of them as we can at the end, or we'll follow up with you later if needed. As always, we're recording this webinar, so I'll send out a copy later today. Feel free to watch it again or share it with any of your colleagues. So without any further ado, just to tackle what we're talking about today, we are going to be talking about the challenges facing ESG and sustainability in finance. And our speakers today are Gwen Safa, who is the head of Sustainable Corporate Solutions at Barclays. Gwen has 20 years of experience in financial services, both in London and in New York. Prior to joining Barclays, she worked at Moody's, where her most recent role involved overseeing parts of Moody's ESG business strategy. And she also has M&A and IPO experience at JP Morgan. And from SESAMm, we have Sylvain Forte, who is our co-founder and CEO. SESAMm is a global leader in ESG and reputational risk data using generative AI. And SESAMm automates portfolio monitoring and due diligence on millions of public and private assets. So without any further ado, I'm going to hand it over to Sylvain and Gwen for the discussion.
Thank you very much, Megan, and thanks very much, Gwen, for joining us after all of the great discussion we had in the past few months. I think this is quite a hot topic, competitive advantage or regulatory burden for sustainability. And I think we can dive straight in if you're okay with this, and maybe start with the big picture view. So the big question right now is, how do you see ESG being framed by the market today? Is it a cost or is it a value driver? And how has that perception evolved from your perspective?
Thanks, Sylvain, and very happy to be on the webinar. Thanks for having me. So I think it's a really interesting question because it's definitely evolved over the last 24 months in particular. What I would say, and this is both in the context of fixed income or equity capital markets, but what I would say is that investors now, when both public and private, when they're looking at ESG, they're expecting the basics to be done, right? So your regulatory alignment, having an ESG governance, an ESG strategy, all of that is not seen as a cherry on the cake. It has to be done. It's the basics. But where we start getting into really interesting conversation is ESG as a value driver, in the sense that if the business of the company is contributing to the transition, right? If there's some product and services sold that contribute to broader sustainability objectives, then we really start looking into ESG as a value driver. And how does that translate? Well, we're seeing an increased amount of Article 8 or Article 9 coming into the capital of those companies. And so it's a very tangible, proof of companies with strong contribution to ESG will see a larger capital pool that tap into those ESG funds. So we're seeing that very clearly. The pendant of that, in a way, is that because the basics of ESG are so mainstream and are expected to be there for any company, for instance, that's going to IPO, you're not really going to get a lot of investor scrutiny on ESG for those companies if all is done, right? If they're aligned with regulatory framework, if they have already an ESG governance in place, etc., you may not have a ton of scrutiny around it simply because it's a screen, we've seen it's in place, we're moving on. And so sometimes we get questions, from companies saying, well, I didn't get an ESG question in my roadshow. Well, it partially is because if the basics are covered, then this is what's needed, and there's not a necessity to scrutinize that further. So I think that's a little bit how we're looking at things.
And have you seen, you were mentioning IPOs, there have been some prominent examples. I'm thinking of like Deliveroo and others, where there was real financial materiality around ESG issues. So there's the element of value driver, there's the element of risk. Do you see this still being a topic in the industry, especially in the context of IPOs?
For sure. And I think, looking at the value driver, it's obviously very exciting. And that's, that's also a new thing, right? Investors were not thinking about it as a value driver up until now. But the reality is that you need to manage your downside risk, right? That's where you start with. And that is really, really important. And I think if we take the example of the Deliveroo IPO that Barclays did not participate into, just full disclaimer here, there were a number of social considerations that had not necessarily been addressed the way they should have pre-IPO. And that definitely had an impact on the pricing at the time. And so that's just an example of making sure that your ESG basics and the key material topic for your business on ESG are known of the management team and are mitigated and addressed. And so yes, it's very exciting to think about ESG as a value driver and new, but you have to cover the basics and make sure that your downside risk is managed really properly, because it will have an impact in some situations. Absolutely.
And can you think of cases where a firm, a corporate, has been able to turn ESG into real strategic advantage, maybe some pure players, etc., in that context?
I think, I flag a few things that we're seeing as, things that are working, if you will, and then I'll name a couple of companies that we're thinking of as well. But what we're seeing at the moment is, especially from investors, right? They really value when ESG consideration are fully integrated into the business, right? So if ESG is seen as a silo, sort of on the side of the business strategy, not fully incorporated, and more of a tick the box exercise, that doesn't get you very far. This is good for your regulatory alignment and not being in any form of regulatory or legal breach, but it's not really driving the business per se. So where we're seeing investors get more excited is when ESG is not a siloed topic, but it's fully integrated into the business model and into the business teams. So you want to see your supply chain guys, your operations guy being involved and really knowing what's their part in the ESG strategy, right? Every sort of like elements of the company, every part of the value of the company really integrating ESG. And that's definitely something that is new and that we were not seeing in the past, right? So I think that's really important. The other thing that's really important is seeing senior accountability for ESG topics. It's great to have a head of ESG somewhere. Obviously, that helps drive the vision, drive the strategy, drive accountability, but you need that sort of C-level accountability as well. So you want to see a CFO or a CEO, a chief risk officer, really accountable for those points as well. Otherwise, it's too easy sort of to park it. This is the responsibility of the team, right? The same way culture, for instance, is the responsibility of everyone in an organization. It's the same here for ESG, right? You want to make sure there's senior accountability at the top, and that in your board setup as well, there is accountability and reporting back around the ESG topics. So I think that's some of the things that are pretty fundamental. And then, when we think about those companies that really integrate ESG, I often think about some of those French ESG pure play. Think of your Veolia, your Schneider. You know that you're buying an ESG play when you're investing into those companies, right? And so those are really prime example of ESG pure play, where you see ESG as a clear value driver. And it's not even, what they do is ESG in a way, right? It's a complete contribution to the transition. And so it's, and then the reason why, and I'll just add that one point, right? The reason why I think it's interesting to look at those two companies, if you look at their issuances, right, from a debt perspective, ESG pure play like that will not necessarily need to issue green label because what they do is a full-on contribution to the transition. And so when they issue a plain vanilla bond, for instance, it's still associated as a contribution to the transition because the proceeds are going to go towards that anyway, given it's a business, geared towards that. So it's also an interesting dynamic to see some of those pure play sometimes abandon, right? Green bonds or not do as much. It doesn't mean that, if you see that volume of green bond being flat or going down, it doesn't mean that there's less focus on financing the transition. It's just that for some of those pure play, it's not a necessity because that's who they are and what they do. So I just think it was worth mentioning as well.
Yeah, that makes a lot of sense. And for us more in the financial industry rather than in the corporate world, we also see some very good examples of ESG being turned into a strategic advantage. And there are quite a few investors that have constructed their entire reputation around ESG and sustainability. And in France, I can think of Swen Capital, for example, on the LP and GP side, or investors like Mirova, where everyone knows in the industry that these guys are really, really good at what they're doing in terms of sustainability, and that significantly participates in asset allocation. It's really part of their core differentiation and key reasons that they are able to raise funds, allocate to the best GPs, be selected, etc., without sacrificing on their ESG consideration and imposing, in the case of Swen or others, in their ESG mandates, strict reporting guidelines, and also like monitoring GPs on a day-to-day basis, including with things like controversies for tracking infrastructure funds, making sure that there are no issues. So I see this also as real differentiation in an asset management world that is getting consolidated and where fees are going down. ESG is also a way to preserve these fees in some situations where the labeling and the actual competence and deep knowledge of the team really match. And that's been quite successful in Europe in general, and I think in France maybe more specific.
No, that's very true. So I think I have a question for you now, because we've been talking. I mean, when I say we, the press, the media, stakeholders have been discussing, some form of ESG backlash over recent years, if not months. There's been noise on the topic, right? Especially in certain areas of the world. So how do you think about that? How do you think about the impact of that noise? Is that going to jeopardize some of our sustainability goals? Is that shift in narrative a big issue in your mind? Like, how are you thinking about that quote unquote backlash?
Yeah, it's a good question. First of all, it is really significant. Like it can't be ignored. It's very clear, and it's something that is happening across firms. So we see a lot of rebranding, for example, and that's a clear sign that companies perceive this as a business risk to use the terms ESG and to invest in that direction. So for some public examples, for example, there was all of this backlash around MSCI and Moody's with the partnership, Moody's discontinuing their ESG activities, and that created a lot of noise in the industry. Something that was maybe more discreet is that S&P has merged their Sustainable One entity with their Commodity Insights business. And that means that ESG becomes a subtopic of energy transition, which is heavily driven by the commodity market. And this is something that we see at rating agency levels. They are, of course, under political scrutiny, so they are particularly exposed to this. But the same thing happens at asset managers, where their own teams sometimes get incorporated into more risk-oriented teams or regulatory teams that are non-ESG branded. And that doesn't mean that the skills and needs are evolving, but the rebranding is very, very strong. And I think it happens differently in different sections of the market. Private equity seems a bit more robust than I'd say to this rebranding than I'd say asset managers in public markets or rating agencies, potentially because they are a bit less exposed to pressure from retail investor groups. So we're seeing that with major banks and asset managers, that the risk of getting into highly publicized lawsuits is actually one of the major pain points that they expect. And private assets seems to be a bit less exposed to this. It's still a premium asset class, and therefore maybe a bit less scrutinized. And also impact investing in private assets is still very, very strong. So there's still, last year, there was a record number of new funds, new green funds and sustainability funds being created in private assets, something that we see less in public assets. So there's definitely a significant effect. There's significant rebranding. There are business impacts for sure on the different players in the market. And there is an overall, I'm hearing that from every provider, every asset manager, every bank, it's the focus on material financial impact rather than regulatory elements. So the drive being less from the regulatory side and more on looking to improve TRIs, etc., in the industry. And so that remains a very material topic, but it's packaged in a slightly different way. And maybe something that we see more in the supply chain sector on corporates is there's also this focus on what's material, what's creating an impact, what's going to bother management at some point. And the underlying topics remain very, very critical and even more critical than before. We had just a few days ago the recent example of LVMH with Loro Piana. So one of their partner companies being accused of subcontracting in China to firms exploiting workers. And that was then placed under judiciary administration by the court just 2 days ago. And I think these kinds of topics right now for corporate like LVMH are probably a lot more interesting than CSRD, for example. So then the regulatory element, though they do a lot of good work on this as well. So that remains very important, but the topic is shifting towards this financial materiality, avoiding downsides with risks, and also generating additional profit, additional ROI, performance for fund.
Yeah. Yeah, and I mean, I completely agree with what you're saying here. We've also seen that change towards financial materiality. I don't know if it's changed, but the pendulum went back into that direction, I guess, which is interesting, right? Because at the end of the day, CSRD was all about double materiality, but somehow the focus on financial impact is very, very obvious at the moment, whether you speak to a corporate or an investor or even some of the other global regulators. And I see it translate in our day-to-day work with clients where we do a lot more of, climate adjusted valuation, for instance, looking at the physical risk impact on, factory cost, impairment, but revenue loss as well, etc. So we've really seen that refocusing and zeroing in on financial impact. I 100% agree with you. That's very clear. And the other point that I did want to make on the topic of the ESG backlash and relabeling, etc. We're seeing that too, right? It's very clear for a variety of reasons. And even if you put on the side the politicization, I think maybe it was time anyway to rethink what are we calling what, right? Is it ESG? Is it sustainability? What does that mean? So it might be anyway a good exercise to think about the best way to name those things and how to label them. But the reality of the day-to-day, I found in my work anyway, is we're not really talking about ESG or sustainability per se. We're really talking about the material issues that are impacting our clients. And it's going to be, supply chain, physical climate risk, obviously transition risk and modeling that, reputational risk and controversies, huge issues, right? Whether on the equity side of things or on your spreads. And so we almost don't really need to call it out. It's just a number of risks, which do require, technical expertise on various topics like supply chain and climate, right? But we almost don't need that label per se because we've moved on, right, from looking at things only holistically. And we've really now gone to that sub-level, if you will, of topics and thematic that are relevant for a given sector or a given geography or, a given company. And so I think it really goes beyond the label in that sense, and it's really focused on those thematics.
Yeah, semantics rather than ESG, but we were discussing that last time, and it's actually creating some strange things in the industry because ESG was a practical acronym because it captured a lot of different things.
I agree.
And so for us, like ESG controversies is becoming like sustainability risk, business conduct risk, supply chain risk. So it makes things like sometimes more difficult to explain where the acronym was helpful. And by the way, I'd say that this rebranding that is happening doesn't really change a lot of the underlying core data and offerings. It's just that it's needed from a business perspective because there are some types of investors or firms where the ESG acronym is now perceived as toxic, especially in the US, and where that rebranding is needed. But sometimes, yeah, it's kind of an exercise in creativity to find the right way to describe the information.
That is fair. At the same time, and that's my last point on that topic. What makes me, hopeful or positive is, ESG considerations when they're material for an organization are getting fully embedded into other function like the risk function, the CFO function, etc. And so you almost don't need at some point, right, to label them necessarily, right? Because if your CRO or CFO is aware that they have an issue with physical risk, right, because too many of their factories are gonna, suffer physical risk exposure and they need to mitigate that, well, they're going to handle that regardless of what broader label we have, right? So the fact that it's been so integrated at this stage we're in, let's call it Western markets, it is helpful. It's different in emerging markets for sure. I think the labeling here might remain quite helpful, but in the more mature market, I think we've gone into a phase where it's so embedded into your day-to-day risk management that it's almost losing by itself its label because it's not required anymore. But to your point, I think in some region that label is helpful to initiate the conversation and really raise awareness about those topics because it's not known with the same level of detail across the globe.
Yeah, and you're very right to focus on thematics. I think we're actually seeing so on our side at SESAMm, we're lucky enough not to be directly exposed to the regulatory backlash because we're perceived more as an operational tool and also beyond ESG. I have friends and colleagues in the industry that had like an entire business based on CSRD, for example, and that business doesn't exist. So there is real business impact in these situations that goes way beyond the rebranding element. So we also have to be aware of this, that the number of players are suffering in the industry due to this. But what I see in terms of thematics is that ESG is making its way into new segments, and supply chain is a huge one right now. So sure, corporates may not care about ESG or supply chain, but they actually very much care about human rights, violation allegations, and child labor and forced labor. And SESAMm is going to announce 2 major partnerships on this soon, where we see controversy data becoming a core element of supply chain and procurement processes. And I think that's also an interesting thing to see that the operational value of ESG in general is getting productized in a number of new thematics and new industries, where prior to that, due to the regulatory pressure, everything was focused on these key topics and on addressing that specific regulatory mandate. So I see this as a good thing, and sometimes it's counterintuitive because why is supply chain so important right now? It's because of tariffs, it's because of trade wars, it's because of these things which typically are not in the political environment of ESG friendly stuff, but is actually accelerating growth in terms of consumption of controversy data, for example. So
For
yeah,
sure.
focus on thematics is going to be very, very key for sure in the next few years.
On your point on supply chain, it is one of the biggest topic that comes up with investors, both investors that are looking at, IPO candidates, but also, growth funds who are looking to invest into ESG software and platform. Supply chain, huge need right now, need for data, need for, deep dive on level 1, 2, 3 supplier network and really understanding what's happening. I mean, the L'Europiana example is an excellent one where it shows you how hard it is for a company like L'Europiana to have access to a tier 3 or a tier 4 supplier and knowing what's happening there, right? This is, having access to that data is very complex. And this is where AI and the work you do, can become, in my view, really, really handy. And the reason, I did want to insist on that for a second, but the reason also why supply chain is so critical is I find that so many ESG controversies, for lack of a better word, are coming from the supply chain, right? And those ESG controversies, they're often the most financially material, right? ESG ratings, they're much more through the cycle, they move less, they move the needle less on financial markets. But ESG controversies, we've seen it with, there was a Volkswagen controversy a couple of years ago around Chinese, workers being involved. And even if it's just an allegation, it moves the market, right? So it's ESG controversies are a massive pain for corporates, and they have to manage them very proactively to avoid having to deal with spreads going in the wrong direction for them, or their equity share price as well. So, yeah, ESG controversies, big important topic, and especially around supply chain because this is where most of them I feel occur, at least the ones that are most market moving. So.
Thanks, Gwen, for your appreciation for
No, but it's true.
controversy data. I appreciate it. And interestingly enough, for supply chain, I've seen supply chain make its way into due diligence, actually. So I was in New York a few weeks ago, and one of our major clients, a big law firm catering to private assets investors. So performing very, very deep due diligence, including a sustainability side due diligence. They are now systematically requesting a list of top suppliers, screening them with our platforms for controversies, but also like controversial activities, business involvements, etc. And this is something that has become very important. Like they had been requesting that type of features for months, more and more actively. And it's an interesting shift. I don't think like that supply chain element was present as much in due diligence inquiries a year ago or 2 years ago. But there are also a lot of good tools now for this, like supply chain mapping is becoming easier. And so it's now more and more difficult to justify that you don't know about your supply chain. And so it makes sense that investors would have a look at it.
For sure.
And maybe on another topic, so we touched on regulation. I think we touched on this a bit. We've seen new ways of regulation in the past few years. Now there is some deregulation, stop the clock, etc. Um, is regulatory pressure still, I'd say, a catalyst for ESG adoption, innovation? Is it just compliance? Is this not the main driver anymore? What are your thoughts on this?
So I think we have to differentiate by region. I will say that to start with. But if I look at, let's call it the Western markets, I think we're past needing regulation as a catalyst or as a trigger, if you will, to focus on ESG considerations. And I've had those conversations since January, right? Since it's been obvious that CSRD, CS3D were getting watered down, posed, dismembered, etc. A lot of our Western European client would say, fine, this is what's happening, but the reality is that it's important to my stakeholders, my shareholders, my investors, and to me, there's a number of key material risks to my business, and so I have no choice but to communicate about them because I've now assessed that this was material to the resilience of my business. So we're in a way shifting the conversation away from regulation as a key driver, but it's much more about, right, it's part of my business resiliency. So how do I demonstrate that I can have a sustainable business, especially for those exposed to physical risk? I mean, what we're seeing in the last 10 days, right, in the US and in Europe between extreme heat and, flash floods, etc., all that is disruptive to businesses, right? So much of that has been now integrated, like I said, by companies, and they have fully understood that this is part of their material risk, that the regulation is not a driver anymore. It's a bit of a pain because there's a lot to be done. And personally, that's not necessarily the Barclays view, but my personal view is that for SMEs, I do welcome a level of watering down because I think it was really, really extensive and very difficult for some SMEs to cope with the load and the level of detail required in year 1 or 2 for those guys was really, really tough, and we've seen it in our pre-IPO processes. But for those Western Europe and even in the US, mature markets, I don't think regulation is a key driver anymore. For other region, yes, definitely, I think that will help. And we're seeing it. There's more and more region in the Middle East, in Asia, obviously, with more and more framework being put in place, and that's obviously triggering a lot of conversation there. So it's quite interesting. But I think we're past that stage in definitely in Europe of needing regulation as a driver. I really do.
Yeah, I agree with this. I don't think it's going to be a big catalyst for the future. I think that also entails risk for the industry because a lot of the ESG related businesses were built upon regulatory pressure. And for management teams, the incentive to invest now in ESG may be a bit more diffuse because regulation was coming next month, next quarter, next year, and that became an imperative. And it may be perceived as a bit less of an urgency and potentially more of a long-term kind of existential risk, which requires a lot of planning in advance and which is difficult, especially in the current environment. I see also that to me that what you're describing, this ESG being more merged into other activities and being seen as a core part of the business. I think this is also the trend that is going to push adoption. We're seeing this, for example, in private markets where there are needs where there's clearly an ESG aspect to them, but there's actually a business need or an efficiency need. Like we have clients that are screening secondaries, for example, or as LPs, screening GP stakes. And there is just an operational need. Is it takes me 3 days to list to evaluate a list of underlying companies of like 200 companies, and I have to do this manually. And now with AI and with data, you can screen for both extreme human rights issues and things like predatory lending and things that are just related to my business, such as I don't want to invest in the meat industry because I have a specific mandate that forces me to not invest in that industry. But what drives the needs here is just I'm taking 3 days to do this manually. And sure, there is an ESG element, but mostly I want to optimize that. And I want this to be faster and to take maybe a few minutes or a few hours at most, which is what we're doing with our AI workflows as well. And yeah, interestingly, this is not the ESG team. This is the secondaries team actually. And
That's right.
and we're seeing the same for like deal teams, etc., where maybe the ESG due diligence doesn't sit on the ESG side. It's just a thing that is embedded into the commercial due diligence report. And that's probably going to be I'd say a good thing in the long term,
Agreed.
as long as it's not watered down too much in the process.
No, completely agree with you. And it needs to be more mainstreamed, right? For people to really, like you said, adopt it fully. So I think I'm going to take an optimistic stance on the way ESG is being incorporated and embedded in companies, day-to-day running. There's maybe one thing I did want to bring up on regulation, to maybe actually balance what I was saying, which is on ETS2 specifically. There's been a little bit of noise in the last few weeks around delays and some pushback, let's just say, around ETS2 rollout. I'm a big believer around carbon pricing, putting a price on it. I think that will help a lot of things, and will avoid a lot of discussions around ESG. Yes, no, is it backlashed, is it not? It's just markets are managing that. There's a price to it, and that has to be properly managed by CFOs and companies. And so I would hope this somehow go through as planned with the current timeline, because I think that will be quite a helpful tool. And obviously the lack of visibility around ETS2 rollout, if you need the date changes, that's a little bit frustrating for CFOs on their hedging strategies and how to prepare for that. And so a bit of clarity around that and making sure that gets rolled out, I think would be helpful. So that's my only caveat around regulation. I do think around carbon pricing, this type of framework is quite helpful in terms of decarbonization trajectory, etc.
That's great. So hopefully regulation can at least solve the carbon element or participate in solving it. Maybe not other aspects, which may be more still operational, etc. But we'll see where this goes. Oh, and by the way, I wanted to mention one thing. Like when we were talking about embedding ESG into other processes and decision, I was speaking about a deal team specifically. Because again, I think everyone's aware that right now ESG due diligence typically sits in another team. Like it's not in the same part of the organization. And this part I really see moving quickly. So in 2 weeks from now, SESAMm is launching a new type of report, which is specifically for private equity deal teams and M&A teams. And it incorporates all of our ESG insights into a report that is more global, that does include like competitive insights, etc., and not just risk, but also opportunities for the company. And this is us adapting to that trend of ESG team not being able to handle everything, but also wanting their processes to be embedded more deeply into the operational day-to-day of other teams. And again, I think this is a great thing both for the financial industry in general and investment decisions because everyone gains knowledge, and that's a good thing. And of course, the ESG person is going to remain a source of knowledge, but doesn't need to operationalize everything.
Yes.
And probably it's a good thing as well for the ESG market. And here, as a data player, we see this as a good sign because the reality is that ESG is a small market and due diligence is a larger market and supply chain is a larger market. So this also has benefits for everyone playing in the ESG industry.
Yeah, no, for sure. Completely agreed. And maybe if I may just add one thing, not quite on topic, but because you've just mentioned risk and opportunities, and I think we haven't talked that much about the opportunity side of things. And I just wanted to give the example of adaptation, right? We can see with what's happening with physical risk right now and the number of, like I said, flood, extreme heat, etc. There's going to be a huge need for adaptation financing, innovation around how to adapt our cities, our environment to those new climates we're facing. And I think there's a lot. I mean, I'm seeing every day, through the Barclays lens, we have our own investing arm, if you will, and a very strong commitment to invest into climate tech startup. And so we're seeing a ton of innovation across various topics, but especially around adaptation, right? So there's also all that aspect of the ESG world, which is around innovation, R&D, to help us contribute to these huge needs around adaptation. And I think that opportunity side of ESG is not to be forgotten because there's huge industry segments, new industry segments that are going to be required, that are going to be coming to life in the coming 20, 30 years, just because of the change of our environment, right? And how we're going to have to cope with it. And so there's a ton of opportunities there as well. And I don't know if it's ESG, right? It's simply adaptation to new climates and making sure we can survive in those new climates. But there's a lot that's going to come from that, and lots of new businesses, lots of growth, to be expected coming from that. So I did want to just touch on that because we've talked a lot about the risk and reputational risk and financial risk, all of that. But there is also a huge amount of opportunities and growth in the overall sustainability sector, in particular in relation to nature and climate, given the sort of inevitability of what's coming our way in terms of climate change.
And that's maybe a good segue into a final question, which is just to wrap up everything. So we've studied a bit the risk side. You commented on the opportunities. We touched on rebranding as well. What is there one thing you note which you feel like most firms are still getting wrong or perhaps misunderstanding when it comes to ESG strategy in the new world today?
So maybe two things. One is, for, I would say, private companies, very often, they still very much consider ESG as a silo. I need to appoint a head of ESG somewhere, and that person will manage it. I think it's important to really make sure, like I said earlier, there is accountability at the CFO, CEO level, and that any ESG risk that is material to the business has to be adopted, mitigated, managed by the C-suite and not just the ESG person. So I think making sure we don't consider ESG as a siloed function, is really critical. And that's something we still see in some of our sort of pre-IPO private company that, are new to the topic and haven't, for very good reason, right, haven't developed a huge expertise around it. But I think that's one thing to really think about. The other point for me is around the financial impact. And the reason I'm bringing that up is it's very difficult to model the financial impact of a number of ESG consideration. But there are more and more providers out there that are trying to model climate risk, nature risk, physical risk, etc. And to me, that's really critical because that allows you to bring a conversation on the CFO table or on the head of M&A table and really think about it from a strategic perspective, right? If my company is exposed, 20% of its valuation has really negative exposure to climate risk, well, you want to know that that's the case. You want to have an understanding of how big your financial exposure is, and then obviously remediate that one way or another. And I don't think we, corporates do enough work yet on that front. So we as a bank try and help, especially around those, climate adjusted valuation. But I do think it's an area that I would love to see adopted more broadly within corporate, because once you put a number on it, it makes it a lot easier to invest, to mitigate, and to monitor progress and success. So I think that's really important. And the last point in relation to that, when I think about the financial impact for a lot of corporates in Europe, I still see, including for large corporate, right? I still see a lot of CFOs not yet fully looped in on ETS2 and the impact that will have on carbon pricing and therefore indirectly on their P&L. And so more work there, I think, will also be helpful because I don't think collectively we have the right estimation in our head of the true financial impact of some of those ESG considerations. So to me, that's the areas I would be focusing on.
Great insights and really appreciate it. And I think from SESAMM's side, the main takeaways that we have in the current market is that probably in terms of ESG strategy, a lot of companies are ignoring major risks that they are not aware of, and they may sometimes react too slowly to them. So I think there is overall in the market too much focus on large companies. And as you were saying before, risks actually emerge in SMEs that may not be as well equipped. But these SMEs are entangled in the global business and they are suppliers of large companies. And yeah, no one is tracking them. No one is really paying attention because they are not large listed companies. But for ESG to be a factor of value, it needs to reflect some of the material financial impact that these controversies notably can have on large companies. And we discussed Loro Piana earlier. When Loro Piana is directly associated with LVMH, with the controversy identified, it is way too late. It is way too late. Everyone is reacting. There's a shock on the market price. Management is in trouble, etc. But there was probably another way to do this, is this small entity could have been better monitored, could have reported in a different way. And so it's our core value at SESAMM is looking to track millions of different companies, including SMEs, supply chain, private subsidiaries, investments, etc. And I do think there still isn't enough focus on this. Private market has made a lot of efforts and so has adopted a lot of the risk management techniques. But I think public assets players cannot ignore this. They cannot ignore that the companies that they invest in are part of a global supply chain and a global environment in which a lot of SMEs sit. And so, yeah, I wish there was a bit more focus on that for the sake of the companies and investors.
For sure. And I think we're starting to see that. More and more providers are starting to look at the private markets, both equity and credit, obviously, and they're thinking about, how can I have an assessment from an ESG perspective for those private companies? What's the best way to do that? And having, I think, great AI is going to be critical for those because, obviously the data is not readily available the same way it is for public entities. So it's going to be an interesting challenge, but I think everyone's realizing they have to focus on the private markets as well, because that's where there's also a lot of risk and opportunities, but risks for sure.
Definitely. Thank you very much, Gwen, for the great discussion. We'll take a few questions from the audience if there's anything. Megan, I don't know if you had noted a few questions, and feel free to ask your questions as well in the chat directly as you see fit.
Yeah, we still have a couple minutes if anyone wants to. Feel free to add your questions as we go. One that came in earlier was that you mentioned that ESG is making its way into other segments like supply chain. Do you see any other areas where it's coming up in prominence, and what would they be?
Yeah, there. Oh,
Go
sorry,
ahead.
please.
Go, Sylvain. Go.
Maybe just a few ones that top of mind because it's product development. And so we're basically branching out from ESG into other topics where we see we can incorporate our indicators. We had a lot of demand from law firms. And so we're translating our ESG due diligence report into legal reports where there is a lot more scrutiny around lawsuits, regulatory enforcement, etc. But there's also a big reputational risk part and also like IP violations, etc. So it's a way to expand beyond ESG. So legal is important, M&A and traditional commercial due diligence for sure. ESG has really made its way into these topics. So I see these as two key priorities in the industry, and supply chain. We talked extensively about it, but this is already something that is done. I would say, like supply chain, ESG is top of mind. However, it's a structure, whether it's business conduct, whether it's sanctions and watch lists and human rights issues, ESG is already there and top of mind for a lot of supply chain.
Yeah, no, completely agreed. And like I say, it's in due diligence now, it's sort of like a basic, topic to cover. So that's fully integrated there as well. I think what we're seeing though is for a number of companies, climate becoming a really, really huge risk, and nature as well, right? And so companies are grappling with that and figuring out how to deal with it, right? So you need the expertise, but it's a risk that is pretty, systemic to the business itself, right? So for a number of sectors, and so that's a huge area of focus. Obviously, supply chain, yes, but if you think about supply chain, it's mostly driven by climate risk, disruption because of climate risk, as well as obviously human rights and social aspects too. But those are really the topics that keep coming up constantly, and including from US clients, right, who will not necessarily talk about ESG, but they will have questions for us on how to better prepare it for their physical risk exposure. First you have to identify it, assess it, value it, then remediate it. And then the same thing, what are my weaknesses in my supply chain? Where are the potential issues? And this then ties into reputational risk, right? So those are the sort of themes we're seeing, ESG mostly looped in, if you will.
All right, and then just one last question this time. It's tackling on AI. So how does a tool like SESAMm or any other AI tool filter between the noise and media sensationalism and actual risk?
Yeah, it's a good topic. There has really been a switch in the past few years from adverse media to controversy, and there is a fundamental difference between the two. So historically, adverse media solutions would raise like a lot of documents, not differentiating between what's really material and what's just negative day to day. And it's because from an AI perspective, they were trained on assessing the level of, let's say, negative sentiment, which is not a good proxy for materiality or severity. And so at SESAMm, we developed a methodology that is closer to a rating agency where we use generative AI and deep learning systems in order to assess legal materiality, level of responsibility, number of stakeholders impacted. Is it local? Is it global? How many consumers or workers are impacted by this controversy? Level of operational materiality, financial risk. And so it's really a fundamental difference because it's now as if you were doing the assessment manually, but you have an AI in the loop addressing that questionnaire in order to say whether this content is actually significant enough to raise a red flag or not. And so that diminishes noise. And this is one of the reasons why at SESAMm we work mostly with qualitative teams, meaning teams of analysts that are looking at the events very deeply. They don't care about like a spike in a sentiment trend. They care about whether this specific event has been properly categorized and is actually severe, and that I should actually take a look at it. So clients like Fitch, AT Finance, InRate rating agencies, for example, also consulting firms, private equity investors, that's really what they are looking for. And so adverse media solutions would not be a good fit. And I think this is kind of revolutionizing the data market in general, moving from adverse media to controversy. Adverse media is everywhere in KYC stuff, etc. So I think that's going to continue to propagate. And it's a good way to propagate ESG topics into these other segments. KYC was another one we can touch on.
Yeah, and maybe the last point is because we talk so much about supply chain, right? And the Lower Pena example, but it's so hard, right, to get into your deep supply chain. Think about an automaker, for instance, and the number of suppliers there is in an automaker supply chain. AI really allows you to go and scrub some local news in local language, etc., in a much more efficient way than we would, right? So I think leveraging AI to be able to make sure you grasp as much as the noise as possible, but then having those analytical teams that can do the work of analyzing whether or not this is a material, I think is obviously critical as well. So it's very complementary, and one without the other, I think, is a potentially an issue.
Great. Well, thank you very much, Gwen. Thank you, Megan, and
Thank
our
you.
marketing team for organizing everything. And thank you to all participants. So we'll get back to you with the documentation and replay of the webinar. Megan, any last words?
No, that's it. Thank you very much to both of you for the great discussion.
Have a great day. Thank you
Thank
again,
you.
Gwen. We really appreciate
Have
it.
a great day, guys.
Bye.
Bye.
Bye.